And go first. Hello, everybody. I am Ferris Musa, one of the partners at both Multifamily Masters and Disrupt Equity. I'm based in Houston, Texas. We have properties throughout Texas and Georgia, and very active buyers and sellers. So we are vertically integrated. We have our own management company as well, and that's really helped kind of give us just a platform really for MFM to continue to grow and help share some of what we've learned to everybody in the audience. And so excited to have everybody on. And for those that don't know, right, Multifamily Masters, we are essentially a group that is based kind of throughout the country. And really the goal is to help create a platform to help people to have their kind of localized meetups, right? One common brand, one common set of things. And so we're excited now that COVID's winding down for people to start to kind of help kick that off. And, I have one of my friends and partners, Pal, on as well. And so, Pal, you want to go ahead and introduce yourself as well?
Sure, absolutely. So I'm Pal Chi. I'm one of the leaders here at Multifamily Masters. Been with the group ever since we started. So I started the group really in 2017. Since then, just a little about me as far as, we started in Los Angeles, and I live in Los Angeles still, although all of my real estate investing has been out of state. So I don't invest in California. It's all out of state. And 2017 is really when I bought my first multifamily deal. It's in Indianapolis. And after that, bought another one a year later. And then in 2019, got involved on the general partnership side of five different syndications. And so I have the background of doing both JVs, doing deals by myself, as well as doing as being on syndications as a general partner. And then when COVID hit, I kind of added a different asset class to my repertoire. So I added self-storage to my repertoire and started buying some self-storage. So I bought my first self-storage deal in 2021 and in January of 2021. So I've had that for about 15 months now. Since then, closed on 6 total in 2021. 6 total self-storage deals. It's just specifically self-storage. Closed my 7th one in February. Number 8 should close in about a week, and number 9 is coming up pretty quickly here. So that's a little bit about me as far as a multifamily and self-storage investor. That's
and Pal, really quick, you've never invested in anything in California, right?
Never invested in anything in California. Yep. Although I live here, and
so it's good for people to know that it works doing out of the estate. And last but not least, we met and we've done a deal together, and we met through this stuff. And so people, I like to just kind of rehash to people, networking works, right? Meeting people in, at events, conferences, webinars. I mean, that's really how we all get started. It's, this is a relationship business, and that's absolutely the way to grow. So glad to have everybody on here.
Absolutely. I think partnerships is one of the big things that Multifamily Masters has brought. There's been, I used to want to count, try to count the people and see how many partnerships have actually formed through Multifamily Masters. And it's been way too many to count. So there's, like Ferris said, him and I have partnered on deals. Ferris has met his business partner. I've met my business partner as well from doing meetups, right? Yeah. Great. Okay. So as far as today goes, what we're going to do is we are really going to have our original plan was we were going to have a panel, kind of a panel, and talk about recent closed deals. But instead of that today, we were actually going to shift it a little bit more to more of an interactive session where we're going to have a lot of questions and answers. We'd like to bring on, we have a special guest here that we're going to bring on as well. And we'd like to really just kind of open this up to more of questions and answers. And because, in our Facebook group, as well as, just Facebook messages and everything that we see a lot of questions that come up. And a lot of times we're not able to really kind of dive deep into those questions. We maybe give answers as much as we can online, but we'd like to be able to dive a little bit deeper into answering people's questions of what they, what do they want to hear, and what's relevant to them, and hopefully we can address those particular questions. So that's what we're going to do today. Towards the end of our session, we'll also probably have a breakout session where we'll get into smaller groups of maybe like 4 or 5 people. Maybe have a 10-minute session to have a small breakout group so you can get to network a little bit more, because Multifamily Masters is really built on this idea of networking, right? And that's really where our focus is networking and forming those partnerships. So we try to give everybody, we facilitate a way to meet some other people and to potentially see where those partnerships take you. Okay. First, you want to introduce your brother, or you want to?
Yeah. So we did get on. I know one of the biggest topics people want to know is about raising money, right? And so Disrupt Equity, we have someone dedicated to essentially investor relations and helping raise money. And he just so happens to be my brother. He's a little bit less charming, a little bit less of an all-around great guy. So, Tarek, do you want to go ahead and hop on and introduce yourself?
And hey guys, hey pal, hi Ferris. Thanks for having me, everyone. Yeah, so to give a little context, I am with Disrupt Equity as well. Ferris is also my brother. I'm the more humble one for those who don't know. So I do tend to take on the investor relations and raising capital. And part of my background actually is I spent years in New York City working in the finance world, over at Blackrock actually. So I'm sure many of you have heard that company before. So we've taken a lot of the connections, the talent, and the skill set, and basically the background from that world and bring it to Disrupt Equity and whatnot, but applying it to the multifamily space in particular now. So that's where what I focus on here at Disrupt Equity, trying to help raise capital and ultimately answer any questions you guys may have around that.
And Tarek, how much have we raised in the past 6 months?
Gosh, we're coming up on close to $100 million, really. Probably a little closer than 6 months, closer to maybe 60. But if you extend it to 12 months, probably closer to 100.
Yeah, so for those on call, lots of, if you want to understand how to raise money, definitely the guy to talk to. So.
Yeah.
And I mean, I guess, Todd, you want to go ahead and moderate and facilitate?
Sure, definitely. And I think we, we appreciate you being here, Tarek. I know that raising capital is one of the main things that people always want to know in doing deals, right? It's like, where's the capital going to come from? Right? If I'm looking at buying, whether it's a $500,000 duplex or triplex, or $10 million property or a $50 million property, there has to be where is you raising money from? And obviously there's some specifics around that and doing it right. So that it's a super important topic, and I'm sure we'll probably have some questions about that as well. Okay, so I know we have a few quick questions that people have written in earlier to us, just to say, just to kind of kick this off. But we're really here to answer your questions. So if you do have any questions, drop them in the chat. And one of us or both of us or as many of us can answer these questions as possible. So, Sarita, was there any? Can we start off with any of the questions?
I actually had a question. Okay. It's about raising capital. So, how do you know that this much money is enough? Like, I don't know how to put this question. Say, for example, it's the deal is I have to raise 30%. So let's say it's about 3 million. I have raised 3 million. Okay. And I have, say, a network of 100 people who are ready to invest with me because of my networking and this and that. Everyone's like, okay, Sarita, when you're saying we are ready to invest. But obviously, when I get the deal at that time, it might be that, some people have had, someone's pregnant or someone's getting married and, at that time, how do you calculate that this many amount of people is what I need? And say, if I go over that threshold, say 3 million, do you say, okay, thanks, I'm all done, I can't take you in? Or how do you approach that as well? Does that make sense? Good. I don't know.
Yeah, no, that's a good question. So how about you take that, Tarek? Do you, when you have a situation, you're going for a raise, how do you manage, manage those investors, whether it's timing, whether it's the amounts? What do you do? You suggest?
Yeah, good question, Sarita. So part of the answer, somewhat depends on where you are in your journey, right? If this is earlier on where you don't really have a track record of success, you don't really have a big network of folks, then obviously you got to kind of take what you can get to some extent, right? But assuming you've kind of built a network of folks who have capital, who've expressed interest, who know who you are, who want to learn more about what you have available, then the way to handle that is when the deal comes around and you have something available to them to invest in, that's when you present it. And those who are actual walkers, not just tire kickers, are going to step up, right? And they're going to offer capital. Now, your question about how much is enough, well, you know, obviously what your minimum is that you require in order to close on the deal. That's something that you would determine with your lender based on your underwriting and all that good stuff. Now, the question kind of extends further to say, well, what if I have raised too much capital, right? The reality is there is such a thing as too much, but up until a certain minimum threshold. The reality is we have to, in our case, for example, we have everything comes as a first come, first serve basis. So if somebody wants to come in and provide all the capital in and of themselves just as one individual, hey, we're done, right? If 100 people behind them want to come in, we really can't accommodate everybody. But the reality is it's not usually one investor, but let's just say we have 100 investors if we're raising a ton of capital and we have another 100 behind them that want to come in, but the first 100 have filled us up, then we're going to close it up at that point, and that's that, right? There will be future opportunities, and this kind of puts a little bit of pressure on some of the investors to realize that, hey, you can't just sit around and wait for things to be done at your own pace. If you don't step up, others will. So there's a little bit of urgency to the matter, right? But to answer the question, the thesis of it is first come, first serve, and let them kind of see who is going to actually materialize and come to the plate.
Yeah, and I'll add to that a little bit, Sarita, just to answer that person's question. So here, what I like to do, and I think, you know, is that you set it up in a way that it rewards people who are going to take action, right? So when you're setting up your raise, you're going to start on a certain day, and probably previously to that, you're going to take as many soft commitments as possible. So these soft commitments, again, they aren't hard commitments because you're not actually taking the money, but you're finding out who's interested. Are you interested? You're talking to some, you know, your buddy from college or something. Hey, I think I'm going to get a deal. Is this something you're interested in? How much would you invest if you wanted to invest? Is it the timing working out for you? You get those kind of soft commitments, and you have an idea of who's going to come in, right? And after you gather as many of those soft commitments as you can, you're going to have a certain day where you're going to say, okay, now it's ready. The documents are ready for everybody to review and sign. And then the bank account is also ready to accept wires. And once that happens, it's really like, you just got to reiterate to people as much as possible. I don't know, first come, first serve, just like Tarek said. That's what we do as well, because it's like, if you're gonna actually do it, I'm probably going to accept your capital versus somebody who kind of said, well, maybe next week, maybe week after, I actually got to clear some money away, and I got to ask some people if I can do it. It's like, okay, I know you're my friend and everything, but like we can't just wait for you the whole time. So it becomes a first come, first serve basis, and then if it fills up, it fills up, right? And the truth is, you're trying to get it to fill up as fast as possible. Now, another thing that we do as well as we'll over raise a little bit, right? Because especially we'll probably over raise maybe 20 to 30%, just to know that like all those people are actually going to wire the money, because people will sign the documents, but that doesn't mean they actually went and wired the money. And then they may say, oh, well, I wired it, or I couldn't go today, I have to go next week. And then there's all those like, okay, well, there's always a little bit of excuses, and then why isn't it coming? And it's like, hey, just over raise a little bit, and then just take somebody else and just say, hey, sorry, you were just too slow. I mean, you looked like you were going to get the documents in, but it took you 4 more days to wire, and somebody else just came in. Other people were just coming in, and they just finished it. So truthfully, there'll be a point where you do cut it off, and you want to get to that, I guess, experience where you can tell people, hey, we are cutting it off. Like, sorry, email goes out to everybody. Thank you for everybody who joined, but we have to cut it off. And you basically cut it off. That also lends people to like give you more credibility and more, I guess, it builds a sense of urgency with your audience that they weren't able to get into the deal. They might have just been thinking about the deal, or they might have just got the email. They didn't really pay attention to it. They didn't really take it that serious, but then they realized, oh, I missed the opportunity. It already happened. And you just tell people, sorry, that's it. So those are some of the other things that I would do as well, just when it comes to raising capital. So
I think Sue wants to ask something. She has raised her hand.
Sure. Okay, Sue, why don't you go off mute, Sue, and ask a question.
Hey everybody, Sue Boudin. I totally agree with you. I had a comment actually on a question because we had a 10-unit apartment complex that we closed on, and we locked up all of our partners. It was a joint venture deal. And 2 weeks before we closed, signed the papers, one of our partners decided to back out. So now what we're doing is, as soon as we have our operating agreement signed by all our partners, they wire the money to escrow to avoid that. But my lessons learned from that experience was that always have a backup to a backup to a backup.
Mhm.
So
Yeah.
always raise the money and having a backup. So yeah.
Maybe that'll kind of maybe condition one of my earlier comments where I mentioned that you could have one investor who funds the whole deal. Well, realistically, you probably don't want to do that unless you know this investor, you've worked with them before, you know they're good for it. Because if somebody comes in, steps up and says that I'm willing to fund the entire deal or a significant portion of the deal, doesn't have to be all of it, and you set all your eggs in that one basket, right, with a few baskets, and somebody ultimately pulls out, then you're in a tight position. Right. So it is better to overraise, kind of to what Pal said. We tend to do about 10 to 20% as well, depending on the deal again, and depending on the individual. But we will also, we're willing to be accommodating to some extent where we'll open it up and ultimately it is a first come, first serve basis. But if we work some before and they're in a situation where they might be working through a custodian, for example, such as an IRA or 401k, some sort of retirement plan, typically that takes a little bit longer to basically obtain the capital. So in those cases, if we know the individual, we know they're good for it, and ultimately the capital's there. It's just a matter of we have to wait for the processing. We'll close it off and hold that spot for them and give them a couple days, maybe a week or so to fulfill. But we would have had a runway in total of maybe 20 to 30 days to raise the capital. So we have some extra time on the back end if we need to take advantage of it.
Mhm. Yeah. Good points. Good points there, Eric. And thank you, Sue. Okay, so one of the things before we get too far into some of the questions, so continue to write some questions in the chat or raise your hand like Sue did, and we can bring you offline and or bring you on and on camera and to ask your question. But also a good thing to do here is if you have your contact information, if you would like to network, you can go ahead and post that inside of the chat as well, so that people can share your contact information. So feel free to put in your name, your email, your business. Don't write a whole paragraph of just nonsense here, but just put your contact information. People would be happy to save that. You can save that later on as well. Okay. All right. So let's see. Sarita, let's see. Somebody else asked another question. What was the question here? Oh, someone asked, what was your worst deal and what did you learn from it? What was the outcome? Okay. You want to go, Tarek? Or I can go as well.
Yeah, sure. So, gosh, where to begin? Every deal has something unique and special about it, right? But I think that ultimately, a lot of this comes down to how conservative you are in your underwriting and your projections. So we tend to be fairly conservative, and ultimately we'd rather underpromise, overdeliver, and hope for things to go better rather than potentially put ourselves in positions to have some pain later on. Now, that said, for us, some of our worst experiences, our worst deals have been related to management companies. I think this is probably no surprise if you've done any sort of real estate investment in the past. I think you've probably experienced firsthand or heard of bad management companies. And in our experience, we've had a handful of them where they just kept dropping the ball. We are a very tech-driven company. We build things from the ground up here. We like to move fast and do things reliably and consistently and have metrics we can track on a reliable basis. Unfortunately, a lot of the real estate industry as a whole is very antiquated with the way that they operate. And to me, it's the most interesting situation because ultimately, I would argue real estate is probably one of the first industries to exist, right? Probably been around as long as land and humans have been around, which is theoretically forever, right? So despite that, a lot of these folks like to operate like they've been around for decades and not really keep up with technology and modernize to the present day. And those have put us in very tight situations where we will set certain expectations or business plans in place for these deals, and these management companies will drop the ball. They will have one excuse after the other, and keep saying, give us another week, give us another month, right? We're going to make it right. And ultimately, after enough excuses, let's call them what they are, we eventually have to pull the trigger and cut ties with them, right? We've had to do that numerous times, but there have been 2 deals in particular where it got so bad and push came to shove where there was just no results after the constant meetings and agreements and new plans that we set forth, that we actually got to the point where we decided, you know what, we cannot rely on these people. And if we want to keep growing as we intend to do as a company, we have to build our own management company and have control our own destiny. So we have since built our own management company called Disrupt Management, and that is what we utilize primarily for our deals going forward. So ultimately, we know that the management is a very, very tough business. Let's be candid. It's not the biggest profit center. There's a ton of staff on there. It's a tough business. It really is. For context, we have more than 100 employees on that side of the business. It's a lot of moving pieces. But at the end of the day, it's a worthwhile headache because it allows our acquisitions, our investment side of the business to flourish. Because ultimately, we know that whenever we put forth the business plan, we can hit those targets with confidence or exceed them. So that is ultimately where our biggest pain points have been, and we have been working on solving that for a long time. We have made a lot of progress on that side, but it can always be improved. But frankly, we're in a very good position now where we know that what we've done in the past can only get better.
Mm-hmm. Yeah, that's great. That's great. I would say that my I don't know if it was worst deal, is my most challenging deal. It was really my first one, right? And it continues to be challenging because I still have that deal. So this one I mentioned I bought by myself in 2017, and that one has been challenging pretty much the whole time. I mean, it's pretty much, I would say it's C- class property, and I had some difficult management issues. So management, again, that became a thing. I don't have my own property management. It's a 40-unit building, so I had to rely on a third-party property manager. And it's in Indianapolis, and I live in LA, so I wasn't going to self-manage this property, and that's not what I wanted to do anyway. I had no thoughts of even self-managing this property. But I would say that the two issues that I had mostly was, I think management was one of them. Second of all, I was undercapitalized. So I bought this by myself. And I had money put away for CapEx, but I ended up spending that money on going and buying another property. And so I was very undercapitalized for a long time. And it really wasn't until earlier this year that I was kind of thinking of like, okay, what am I going to do? The great thing is that I bought it very cheap. So kind of been, basically breaking even this whole time that I've had it. However, what I decided to do was either sell it or bring on a partner. And I decided to bring on a partner. And so now it's in a very different state, and it's getting to that very different state than it was previously. So I would say, we're put in a lot more money into the CapEx side of things, and now we're really kind of really upgrading a good portion of the property. So it's really kind of in that turnaround phase. So I would say it's not turned around yet, but it's in that turnaround phase when we put in a lot of work and a lot more money towards it. And I think those are the two big lessons that I learned from it, is really, like I said, making sure you have good property management, which I feel like my property management now is much better equipped to do it, to achieve our goals. And the second thing is, don't be undercapitalized. As if you're undercapitalized, that can really, really put a strain on you for a long time. So don't get in that position.
Yeah, and I think maybe just as a corollary to this, part of the way to maybe protect yourself from those situations and avoid these bad situations really is going to come down to, first of all, getting referrals, not for property management companies, to ensure that they are able to walk the walk and not just talk it. But once you actually want to buy the property, don't just rely on your due diligence, right? Or your underwriting. That's a great starting point, of course, but you don't really know the reality until you get on the property and start walking it. So be very, very diligent during your due diligence period, right? When you actually visit the property, find out exactly what it needs. Plan for the worst case scenarios, right? We've had floods, we've had gangsters, we've had prostitutes, we've had it all on our property, we've had murders even before, right? Plan for everything, and ultimately have reserves for those contingencies. Hope for the best, but prepare for the worst. And if you do that properly, then you should be in a pretty good position where it's okay to have some reserves on hand that you never need to dip into, but it would be terrible to need to dip into them and not have them available. So plan accordingly.
Yeah. And I would say that another good lesson that I learned from this was really to partner with people. I mean, there's certain things that I'm good at. There's certain things that I'm not so good at. And when you have a deal and you're doing it all by yourself, yes, you get all the profits, you get everything and whatever. You get all of it, right? It's 100% yours, and you get make all the decisions, everything. But that also means, if you're, I guess, anywhat similar to me, is that you're good at some of the things and you're not so good at some of the things. And you want to spend time on some of the things, and you don't really want to spend a lot of times on these other things. But guess what? You have to do all of it. And so I personally do not really want to be in that same situation. Now, I don't necessarily need to have 50 different partners or anything, but I do want to have a really core group of partners that I can feel like, hey, they can take this on because they really like doing that stuff, or they're very good at that particular thing. I'm much better at this thing. We can work together and really achieve more success and be, I guess, more engaged with the property in a better way.
And in reality, if you have some weaknesses that offset your strengths, then having all the profits of $0 of profit is nothing, right? We are very big on collaboration here. Ultimately, that's why this MFM exists in the first place, why we're all here. And we would rather have a smaller piece of a much larger pie with the right partners that we can share it with.
Absolutely. Okay, great. Let's see, Sarita, what was I think the next question was difference between a JV and a syndication. Difference between a JV and a syndication. Let's see, I'll go ahead and take that. So when you structure a deal, okay, when you're structuring with multiple partners, right? There's different strategy you can do. Now, typically two of the very, very popular ones right now are to do a joint venture, which is generally a smaller group of people, right? So I don't know, whatever, 5, 10 people, whatever, something small. And you are going to go take down a property with everybody in that group. Now, everybody has to have an active role in the joint venture, right? So part of the thing is you're not taking money from people passively, that everybody has an active role inside of this deal. And so that's a great opportunity to do it. Like I did that with some friends and family, go buy my first second deal with friends and family, or my first self-storage deal, friends and family, right? Just a small group of us. You get a little limited in terms of, how much money will come in, right? So if you're going to get a deal that's, say the deal is $5 million. Well, if you're going to have to come up with 20%, it's not the easiest thing to come up with $1 million between 5 people, right? There's certainly groups that can do it, but if you're just kind of starting out, that may not be your network yet, right? So you may be limited in terms of the amount of money that can come in. So it's the size of properties that you can go get. So that might be, there's some benefits as well as disadvantages of a joint venture. Now, syndication, on the other hand, is a little bit different structure, right? So now what you're doing is you're pooling together a larger group of people, and you're pulling together their money, everybody's money, right? Now, many of them in a syndication, there's generally broken down between 2 different groups inside of the syndication. One is called the general partners. They are the active partners, right? They are the people that are making the decisions on the property. They found the property, underwrote it. They're getting the loan, signing on the loan. They're making the operational decisions. That's the general partnership. They're raising capital. There's also the limited partnerships, which is the people that are passive in the deal. So they are investing money, but they're not involved in any of necessarily the rights or the decision-making that goes on with the deal. Now, so that's a different type of structure, right? So now you can have a larger pool of people that are investing, so you could potentially take down a larger deal. There are some rules about, what type of syndication and things like that. But in general, that's what you're looking at as far as the differences. A joint venture is probably a smaller group, probably taking a smaller deal. It depends on how much everybody's able to bring. Everybody has to be active. Syndication, there is 2 different groups inside the syndication. One is the active group, which is the general partnership. They are the ones making the decisions. And the second group is the limited partnership, the limited partners, who are really the passive investors inside of the deal. Okay, so those are really the 2 distinctions between a syndication and a joint venture.
To ask a sub question to that. So general partners, what all different roles do they have? Like, I know there is a partner who would bring the money in. So, the one who signs on the deal and, the KP. So can you just give a breakdown of maybe a couple roles that are key and important to have when you are thinking about general partners? Sure.
And actually, hey, I see Garrison. I see that you joined, buddy. What's going on, buddy? You want to? Hey, do you want to come off mute? Do you want to answer that question?
The crazy thing is I just got off of a capital raising call. So I break my teams down a little bit further than probably what Pal might have described. I have someone who handles absolutely everything, even down to the minute detail of, I have one girl, Teresa. I don't know if she's on this call or not. She does nothing but call and check for insurance for us. My whole team raises capital. I have another 2 people that do nothing but due diligence and property inspections and lining up the property inspector and things of that sort. On top of, I have 2 individuals that do the asset management portion of it. We babysit the babysitter, which is the property manager. Property managers are great until they're not great. They generally start out really, really strong, and they start to tail off as the project goes, very similar to contractors. So that's probably the main 3 or 4 points, on top of course, one person signed for the loan, sometimes 2 people, depending on what net wealth is required. 1 or 2 people might be coming in with the bank balance, the liquidity aspect of it. And 1 person, 2 people, normally I'm the person that comes in with the resume experience of it. I have 21 years of nothing but real estate. I think I covered most of the aspects of my team. What did I miss, Pal? And what did I miss, Tariq? Tariq, your team's way bigger than ours.
Yeah, we've grown quite a bit over the years. But to the point, at the end of the day, there are certain functions that every deal has to have. The question is, which roles can you provide and play yourself versus what do you need to bring in partners for, right? Garrison kind of hit the highlights of them. There's someone who has to manage who basically asset manage the deal, somebody who's going to manage the property manager, which is the asset manager effectively, someone who's got to raise capital, and then someone who's really going to just manage the operations as a whole, right? And there's all these other small little pieces going, but those are kind of the big categories. So ultimately, which ones do you have the skill set and the competence and the comfort to be able to provide? And then which ones do you need to supplement with someone else? So that's where the partnership, and again, this kind of platform makes a lot of sense to work with.
Mm-hmm. Yep. So Sarita, in all of that, the more that you can do, the more value that you bring to the table, right? So and just for anybody, right? So if you have, if you're able to sign on the loan, if maybe your net worth or liquidity is strong, then that's going to be important. And plus, if you can raise some capital, that's great. And if you have some, you're able to underwrite deals, hey, even better. And if like whatever you can bring to the table, that's going to make you more valuable to your particular team. Right.
And what Pal just mentioned is one side of the equation. If I'm brand new to this business, I'm trying to add value to someone else. But now that I'm several years into this, right? I built my team, and my team got a lot larger. And your team's a lot larger. You're giving away too many pieces of the pie, Garrison. Long story short, I would rather have someone else who wants to learn this by doing it and wants to learn it by doing it the right way. I'd rather have them do all the little minute details while I get to sit back, take some pressure off of my shoulders, because we make more money when I'm out there negotiating with brokers, looking for the next deal, raising capital, things of that sort.
Awesome. Okay. Let's see, Sarita. Somebody else wrote in another question. When underwriting, what all factors do you keep in mind that might significantly change the outcome? Okay.
Mr. Chris Collins joined the call, my man.
I know. I was like, wow.
Hey, what's up, Chris? How you doing?
Chris, field some of these questions, man. You're super knowledgeable.
Let me see if I got my just setting up this new computer. How's everybody?
Okay.
Awesome.
Well,
anyone who doesn't know Chris Collins, shoot that dude a friend request. Instagram, Facebook. This guy does a lot of deals. Just a great person to surround yourself with, for sure.
Absolutely.
Man.
So
I just find anytime Garrison's in a room, then I show up and he says nice things about you. That's
I'm going to comment on my buddy. One of my coaching students is here, Raymond. This guy, he's got a good looking outfit on. What are you wearing, Raymond?
My comfortable plaid.
I like it, man. You're in upstate California. Where is it? Humboldt County, is that right?
Mendocino County. Yeah. I just sent my first round of postcards direct to seller. I think they're probably the most terrible postcards I've ever made, but done's better than perfect.
My man,
Sure.
You go.
Absolutely.
love that attitude. That's great.
Where did Vessi go? Vessi, are you here?
I saw her a minute ago. She's still here. She just turned her camera on. Look at that.
Hey, Vessi.
Hello.
Vessi, give us a little bio about yourself, and then answer this question for us, please, about what are some factors to keep in mind that can significantly change outcomes when you're doing your underwriting. So give us a little bio and then answer that question for us.
Brief bio, based in LA, California, similar to most Californians, invest out of state. Tennessee, Central Florida is where I started in the residential space, and now making the transition to multifamily, closing on 2 properties soon, meaning within the next 2 to 3 weeks. Underwriting, one of my favorite topics. A couple of metrics that can significantly change the outcome. Rent growth assumptions, that's one of them. And I can dive into each one if or as needed. Cap rates, starting cap rate and reversion cap rate, expense ratios, and of course your financing terms. That's a very high level summary, but I can dive deeper if needed.
Sure. So just give us an idea of rent growth. What are you seeing? What are you thinking for? And in a way of what you're projecting for rent growth, and give us an idea of what markets too, because obviously rent growth in certain markets may be different. So.
Absolutely. So the markets I focus on for deal searching or deal finding are Tampa, Central Florida, and Jacksonville. All three markets have experienced phenomenal rent growth over the past couple of years. So the key question is, will that be sustained? Usually I like to consult with my local boots on the ground property managers when I validate those rent assumptions. The outlook for this year is still pretty strong, probably another 10% to 15% growth. But the consensus is it is expected that those rent growth numbers will start tapering down back to more of a normal in the long run. So personally, when I underwrite, try to be more conservative. So I start off with a lower number, certainly not 15%, even though that's somewhat expected in year one, and taper off in year 2 or 3. That's how I usually approach it. I guess if you see aggressive assumptions in anyone's underwriting, then just ask the question and maybe validate that either through comps and other third parties that could potentially warrant that.
Yeah, very good. I appreciate that. And maybe just talk about cap rates. You brought in a entry cap rate versus exit cap rate and reversion cap rates. Explain to people what you mean by that and how that would affect their underwriting or their values.
Absolutely. So the entry cap rate, usually that's the market cap rate, which may or may not be the same as your purchase price cap rates. Particularly in the current competitive environment, those are being compressed even further. And so that's typically your starting point. Again, get a room of real estate investors in a room and you can get a lot of varying opinions on where cap rates will go. But for prudent or more conservative underwriting, the better practice is to assume those will increase in the long run. If they don't, then that's added bonus. So anywhere from 10 to 25 basis points increase per year is what I've seen in underwriting. Why does it matter? Well, because it affects your valuation, which is NOI divided by cap rate, and it functions almost like a multiple. So it can have a pretty significant impact on your exit valuation and therefore projected returns.
Yeah, very good, very good.
And that exit cap rate is probably one of the most sensitive numbers that people manipulate in order to make a not so good deal look super good. Something to keep in mind.
It's very easy. It's very easy to do, right? It's to make the numbers fit your narrative for sure.
Yep.
Thank you, Vessi. That was very good. That was very good.
Vessi, I feel like you should host you on some type of interview. You're good.
I know you guys all owe Vessi $50 for the underwriting lesson. Okay. So okay.
Hey, hold on. One more question for Vessi. Where's your accent from? It sounds like Virginia. Where are you from?
Born and raised in Virginia, yes. Born and raised in Bulgaria. I'm Bulgarian, Armenian, American. So blend of lots of different cultures. But
love it.
Yeah.
Go, sister.
Okay. Awesome. Okay, so let's see.
Yeah, I'll jump in here really quick, pal.
Go for it.
While I'm at it, I know Vessi was talking about like rental rates and seeing when you're underwriting, like what makes sense. I think one thing that's really helpful and very practical and something you can do when you're checking out a property is to go look at all the comps around there. And to me, what I try to do is I find kind of comparable, this is what our property looks like and what it, what's going to rent similar. But then I find like the high end, like, okay, like we bought a property in Jacksonville and our rents were like here. And I found a property down the street that had like boat docks and basketball courts and garages for all the units. And I'm like, okay, we will never get to that rate, right? This is out of our range. So if we're underwriting beneath there, cool. But if I see underwriting that's like above that, it's just a red flag that like, okay, these properties are not getting anywhere near that. So it's a good practical, anyone can do it just by driving around. And plus you start getting that feel of what other properties feel like. And that feel is something that, I mean, Grant Cardone talks about it all the time. It's like, he just goes and walks a property and looks around and feels like what it feels like to be there. And you'll start, if you're kind of newer and you haven't walked a lot of properties and you haven't underwritten properties and haven't looking at what makes sense to raise rents to, it's like, I don't know, can it go from 800 to 1,000? Sure, I don't know. But if you look up the street and they're only getting 950 and they're a way nicer property, it's like, are you going to get to 950? Maybe, but if they're saying you're getting to 1,100, maybe second guess that. So just a practical quick tip for you.
Very good point. Very good point. And something to piggyback off of what Chris just said, Raymond might be able to vouch for this. I tell all of my coaching students, I tell all of our Multifamily Masters Mastermind students, spend time at properties. Go hang out. When you take your wife on a date or your husband on a date or whatever, Friday night, date night, stop by an apartment complex, drive through it. Just look at the cars in the parking lot, look at the windows, look at the blinds, the shutters, the roof, the trash, the people hanging out, get familiar, get acclimated, because you don't want to go look at your first apartment building and be like, oh, this is great. I love it. I want to buy it. But you have nothing to compare it to. And a year later, you're like, holy hell, this is a shithole. And I've seen people do it all the time. You don't know what you don't know. Just something to keep in mind, and, make it fun. Take your wife, take your spouse, take your kids, take whoever, and go hang out at these complexes that you're interested in buying, and get your spouse and your family excited about this business as well while you're learning.
Yeah, that's great stuff. Let me see. Bessie, you did have a question here, and I think that's a good question to bring up. It says, I'll just read it for you. What strategies have worked well for you to successfully expand your ability to attract capital beyond friends and family who may be tapped out or hesitant to invest? So getting beyond friends and family, we have a number of different people here who have raised capital and have been very successful at raising capital. So going beyond friends and family, what ways has been successful for you? So maybe Tarek, you want to jump in here?
Oh, wait. Yeah, here we go. Okay. So this is the fun stuff, right? Ultimately, the answer depends on what kind of person or entity or group you're looking to get to, right? And where you are on your journey once again. So earlier on in the process, of course, you're going to probably have to rely on close folks, friends, family, your social circle, let's say, right? But at some point you tap them out and you really need to start expanding beyond that. Now, logically, you probably still don't have a huge track record. You probably don't need a ton of capital yet. So the logical answer is to find more what they call retail investors, right? Individuals. And that could be folks from meetups. That's a good place where we've used a lot of that, right? Even not just local meetups, but even virtual meetups like this one, right? Find other folks who are interested in this kind of asset class, looking for investment opportunities, and trying to ultimately procure capital from them. Now, at some point, you probably want to tap into individuals who have higher net worths, right? More capital to spend than fewer. So ultimately, that's another still category of retail investors, but going after high net worth individuals. Now, assuming you've kind of tapped out the market, or maybe you feel like you haven't really found additional opportunities that will suffice for what your needs, then it probably makes sense to expand and try to JV with another co-sponsor, right? You have your equity pool of contacts, they have their equity pool of contacts, and try to join forces together. Yes, you're probably going to give up some GP in the process, right? But ultimately, you're trading off one positive for another, right? So you weigh things. At some point, assuming you've got a good established track record, you've got a lot of capital of deals, you can walk the walk and you're a player, right? Then it makes sense at some point to narrow it down a little bit and get more money from fewer people. And that's where the areas where there's already pooled capital comes into play, right? Private equity, family offices, other institutions, but those folks usually their capital comes with strings attached typically. So you want to make sure that you have your show really well buttoned up, you know what you're doing, and that you know your numbers very tightly, because you can see what you can negotiate or what you can push back on in order to get their capital. Because ultimately, if we raise capital from 300 people, which we've done before in a single deal before, that's a lot of paperwork. That's a lot of communication, a lot of calls, a lot of emails, a lot of everything, right? And on the back end, of course, every year we got to do K1s and taxes for those folks. It's a ton of processing to take care of that, a lot of manpower. Ultimately, if I can find one institution who can stroke one check and be done, that's a lot easier on me, right? But ultimately, that's going to be a lot more difficult for me to get, especially early on in my career. But later on, once we prove to them we know what we're doing, here's our tracker of sales, here are our results to back it all up, they know that they have basically mitigated their risk and that they're not going to be putting their investors' capital at risk in a place for potential loss, then it makes sense to have those conversations. So it's a journey that you have to grow into. A lot of people want to jump the gun and just go straight to the big guys, right? I've literally had somebody say, hey, how can I get Blackrock to invest in my deal? I'm like, this is literally your first deal. They don't even know who you are. They don't care to know who you are. These are guys with $10 trillion under management, right? A $10 million deal, it's a drop in the bucket, right? Drop in the ocean, frankly. So you have to work your way up to it, but that's the way that I would start. Focus on the retail, grow into high net worth individuals, then start going into pooled capital like institutions and so on.
Okay, that's awesome. That's awesome as a overall. Chris, why don't you give us an idea? I know that you've raised capital not only from probably initial friends and family, but you've grown that friends and family to a larger network, right? And even beyond that. So why don't you give us some idea of like things that have been successful for you when it comes to raising capital beyond just, your initial friends and family?
Sure. I mean, I think that the biggest kind of easy thing is that you just always be talking about it, always have it on the tip of your tongue, always have something you're talking about. Oh, hey, we just sold a deal in Florida. I just got a check for it. You know what I mean? Like you just have something to be able to talk about in any given situation. Have it be kind of your main thing that you do, and I mean, Garrison and I have talked this before where, you bring it up and if it's the conversation activates and it kind of like, oh, really? Tell me about that. Then you can jump into it. And if it doesn't, don't push it because it gets to be, you're the annoying guy that's always talking about real estate. So have it available, but don't push it too hard. Finding anywhere that you can go be online and just have a presence and be consistent is kind of one thing that will pay off. It's something that I haven't been that great at during COVID, to be candid. And I've talked to Pal about it a bunch, but like just jumping on, like not a guarantee, but if you spent the next 30 days and did a live video every day, you'd be shocked at how many people just start calling you in day 31, day 35, day 40. It's like a almost guaranteed way to expand your email list, expand your investor list. And not everyone's going to call you and be like, hey man, I got 100 grand I want to invest, but they're going to start those conversations and that will lead to down the line, people who invest with you. Another, I guess, quick tip I would say is if you're at an event where you're able to speak, you're able to be the person that's up on stage or whatever it is, take advantage of that opportunity, but then also acknowledge that when you kind of step into that level, you gain a sense of credibility. And I had a scenario once where I was at a speaking event in, where was it, Carlsbad, and I'd kind of been raising a lot of money in like $50,000 chunks, $60,000 chunks, a couple $100,000 checks, but it was kind of in that range. And I had a guy come up to me and he's like, so what's your investment minimum? And I had this mentality of like, well, it's 50. Sometimes we can do a little bit less, but it kind of depends. And he literally like laughed it off. I was like, oh, like, never mind. And he was thinking, why so low? Like his mentality was like, oh, I was thinking like 100, 200, 300. You're talking about these small deals. And so it was a very humbling experience to realize like my response should be something like, well, what are you looking for? We have kind of different deals for all levels. And you kind of feel that from them rather than you assume that they're going to want low by asking that question. So there's like a small takeaway that impacted me forever, that someone might want to write you a larger check than you may be expecting. So that'd be kind of my main things: be online, be social, have it on your tip of your tongue, and then look for larger amounts if it's there, because you never know what that person might be looking for, no matter how they ask it.
Yeah, yep. That's awesome. Awesome. Garrison, you got anything to add here?
I'll say very similar to what Chris said, always plant that seed. I tell every coaching student, I probably said this to Raymond before. If Raymond and I went to the beach this weekend and we got absolutely wasted and just hung out all weekend, If Vessi, if I see you on Monday or next week or whatever, you're like, Harrison, haven't seen you in a while, what's up? You know, my reply is not, hey, me and my buddy went to the beach all weekend. Instead, it's like, hey, me and Raymond, we sat around and we been analyzing properties. I'm looking for another apartment building to purchase. So I'm just always planting that seed and kind of sparking that conversation. Like Chris said, if they're not excited about that conversation, if I'm on a ski lift, right? I always have an elevator pitch. If I'm on a ski lift and I'm like, hey, what do you do for work? What's their reply? Well, I do this. What do you do? That's when I go into the real estate. And if they look the other way, like, hey, it looks like it's going to snow. No harm, no foul, on to the next thing. But a lot of times they're like, oh, what do you mean people like me? You help people like me invest into real estate? I don't have any money. Sure you do. You got a 401k, you got a self-directed IRA, you got cash in the bank, blah, 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 blah. You know, and another good point, a different level from what Tariq said. I'm pretty new at raising capital, actually. You know, I brought a lot of money home from China and I was able to pay cash for a lot of stuff for a lot of period of time. And now I'm starting to raise capital. I just got off of a capital raise call. We tapped down at 100 people. That was absolutely fantastic. We set this call up 2 days ago. How did I get 100 people? I reached out to my friends. Chris, do you want to be part of, and just say Chris is a little bit more rookie than what Chris actually is. Chris, do you want a part of a GP spot? You can help me with asset management. Tell all of your friends and family about our deal. You get them on the call. I'll sell it. I'll present it. But Chris, you bring in your network. Pal, you bring in your network. Vessi, you bring in your network. And now I got 3 or 4 people feeding people into my funnel. And then we do deals together. And hey, you know what? Maybe Chris and I, we love each other after the first deal. Let's do it again, Chris. This was rock star. On the other hand, maybe it's Pal. Man, I don't like working with Pal. Pal's lazy. So you know what? I don't want to deal with Pal next time. But in general, you know, that's how I did it. I'm not saying I did it the best way, but I did what worked for me. I played off of my network's network.
Mm-hmm. That's all good points. So, I mean, you can take a ton away from all 3 of them as far as like, you know, they've all been able to raise a lot of money and, you know, go beyond the initial friends and family. And
hold on, pal. Yep. Pal, I used to be so jealous of this guy. He started real estate way behind me and he started raising a boatload of money, right? And this is how Multifamily Masters was formed. Pal would get on here and say, hey, I started Multifamily Masters. I did this and that. Really what happened was Pal and I were at a conference. He started buying all these deals. I was like, dude, how did he do this? He's like, I got 10 meetups in California. I was like, interesting. I thought about it for 2 weeks, couple weeks. I then called Pal up and I said, hey, I'm going to start 100 meetups across the country. If you did awesome with 10, I'm going to do 100. If you want to be part of this, let's rock and roll. And so Pal, with that being said, like he was raising capital before capital because of meetups and whatnot. But what was you skyrocketed right out of the gate. You took off way faster than I did. What was your secret sauce?
I mean, very, very similar to what you guys were talking about, right? Is that you want to tell as many people what you're doing as possible, right? Like I have this, if anybody knows me, I play beach volleyball, right? Beach volleyball has really nothing to do with real estate. But everybody there on my beach volleyball crew, they all know that I do real estate. So whenever something's happening, they all know about it. And I get actually investors through beach volleyball, right? And it's like, there are people that are interested. Now, not everybody, you know, not everybody wants to talk about real estate while we're playing beach volleyball. So, but there are people that are interested and they've invested with me. And beyond that, like Chris said, if you can get a platform, which is maybe it's a meetup, maybe you start a chapter of Multifamily Masters meetup in your location. And that's what we give the opportunity for people to do. And that's what I did. You know, Chris and I were co-leaders of our location for a long time. And we brought in people. We always had a really good turnout of people that would come to our event. And, you know, when you start shaking hands with a lot of people, you know, people get really interested in what you're doing. And they know you and trust you. And that's the thing that, you know, people really know and trust you and they're investing with you, right? They're not really, you know, they look on paper and they look at, you know, okay, this deal, well, truthfully, that deal looks a lot like that other deal and probably looks like the other 5 other deals that they saw, right? The numbers are very close to the same, probably similar markets. It's really, they're trusting you. Like you're inside of that deal. Why are you inside of that deal? Okay. And I like you and I trust that you've done your homework and that you are going to make this successful and you're going to look out for your people, right? So, you know, because once you get sort of beyond that, you get to that trust level, people will really, I mean, they're more, I don't know, I don't want to say blindly, but they're just going to be like, okay, what deal do you like? You like this deal because of what? All right, it sounds like a good deal. They just are going to go for it because you said it is, right? And you want to get to that level. The other thing is, like, what I like to do is I like to bring more value, as much value as possible, to the people that are investing with me. So those people who are now inside of my joint ventures, they're getting basically trained and experienced, and they get transparency as much as possible so that they can go off and do their own deal. Because I know that people aren't going to just stay inside of my deals all the time. They're going to want to do their own deal. So I'm trying to teach them as much as possible and give them as much hands-on experience so that they can go off and do their own deal. And to me, people find that, like, hey, actually, I could probably be involved in many people's deals. I have enough money to be involved in any of these people's deals. But the reason they're probably choosing me and getting inside of my deals is because I'm offering them a lot of that transparency and decision making, as well as, like, teaching them, like, how to go and do this themselves, right? It's not just like, oh, get inside the deal and then you get some updates here and there, or things like that. It's like, no, you actually are involved in the conversation. You're actually exposed to other things that I'm exposed to, right? So you get experience, like, through somebody else. So to me, that's been probably the avenue that I've had the most success with, especially lately. And nowadays, I just get a lot of people that are really interested, and I just kind of know my avatar. I know the people that want to invest with me, and I know what they want, and I'm trying to give them that, and that's a lot of value.
Vouch for Powell there. I mean, everything he says dead on. Like, I've been on those calls and he's very transparent, and you get a sense that he is open and he will tell you, like, you don't get, nothing's hidden, you're not going to get that. I don't know. I feel like there's something he knows he's not telling me. Like, he's transparent. So if you ever get a chance to be on those calls and look at his deals, highly recommend.
Appreciate it. Thank you, Chris. Okay, so I want to go to the next question, but for some reason my mouse just died, so I can't scroll, and it's like stuck on the screen right now. So it's just,
here's a question for you, Pal. Pal, here's a question for you. Have you and Chris ever done deals together after hosting meetups and building that part of the business?
We haven't, but we've talked probably like 3 or 4 times about, like, hey, let's get on the next deal. So I mean, literally, we just had some text messages flying back and forth, about 30 of them earlier today, about kind of like what's the deals and what's going on and things like that. So we haven't yet, but I mean, Chris knows that he's one of the first guys that I reach out to a lot of times, and just like let him know, hey, there's another deal coming up. Where are you at? So,
hey, if your mouse died, can I scroll through a couple of these questions?
Yeah, you could take that part over for me, please.
I'm just going to start at the end and work my way up it. This is from Alan Gordon. I'm still not clear about being a resident of California and creating an LLC for a property in another state. Do I need to register the LLC in California and pay the minimum tax of $800 for a small deal? No, you do not. I use a company called registeredagent.com. I set all of my LLCs up in Delaware, approximately $200 a year, no state income tax. And it is, what's the word I'm looking for? My name shows up nowhere. It's anonymous. So that's how I set my LLCs up. How?
Can you type the address, the link of the site that you just mentioned, please?
Residentagent.com,
I think it is.
There, just so you know, whoever answered that question too. I mean, obviously, we're not lawyers or CPAs or anything. So you should really talk to those people to get your advice really from them, right? So, but in general, when you are buying a property that's, say, out of state, you usually want the LLC that's going to own that property to be either in that state or in a state that your lawyer is recommending. So maybe Garrison's lawyer is recommending Delaware, or if the property is in Tennessee, maybe they're going to recommend Tennessee, but you're going to want to get a recommendation from a lawyer of where to host that LLC, right? So most of the time it's in that state that you're buying it. Okay. Go ahead with more questions here, Garrison. Oh, also too, we got about, I would say, 8 more minutes before we break into the breakout session. So
Unfortunately, I can't read any more questions. This thing only goes back into when I logged in. I didn't realize that's how Zoom was.
Okay, Sarita, you got a.
can see them all.
I have here one. Give me a minute. Someone asked about underwriting. Yeah, so Chad was asking, what are your favorite metrics to use to underwrite a deal? What ones can make or break a deal?
Go ahead, Chris. What do you underwrite? What do you do when you underwrite?
So for me, it boils down to a couple main things. It's your exit price, exit cap, and your projected rental rates. There's a lot of small things that are going to make big plays, like how your construction renovation budget is going to play out in real life. But at the end of the day, what I'm trying to get a good sense of is we're going to sell this deal for a 4 cap, and we bought it at 70 a door, and we're going to sell it for 160 a door. Kind of back to similar earlier where I was saying, like, if you go walk a property, does it feel like you're going to rent it for $1,000? I kind of do the same thing on exit price. Am I going to be able to sell this property for 160 a door? You know, like, I'll try and talk to the brokers and go, is that a real number? And I've been really surprised over the last couple of years. So I've been kind of over conservative on a lot of deals where now we're selling it for those numbers. And I was like, I don't know if we're going to get that, but so that's a big no, is what kind of exit price you're going to get, who's going to buy it for those prices. You know, is another investor in this room going to buy it for 160 a door, or are they going to be looking at it for 70 a door? Okay, if they want it for 70, who's buying it for 160? So I'm looking for like kind of real, what are real numbers, and brokers will give you that good idea. Lenders will give you that as a good idea, and other investors who are kind of high level will give you that. And that's kind of going to come from networking. But and then average rent rates. Like if you think you're going to buy it now at 800, you know, you're renting for 800, but you're going to try and project that you're getting 1,050 when you sell it. Because a lot of these numbers, when you're underwriting, it all has to do with when you sell it. Everything along the way is like gray area until you sell it. And that's what these big numbers that you're going to get projected and go, hey, we're going to double your money in 5 years or 6 years or 4 years, whatever it is. Those are a lot of based on what you exited at. So to me, these are numbers that you can practically feel out. I can call the properties around and see, what are you renting for now? Do you have any specials right now? Or are you actually getting 900, you know, for your rent, whatever it is? So are the rents that we're seeing that we're going to get in year 4 and 5, if we think we're going to get it from $800 now and we're going to get it to 1,000 by the time we sell it, is that realistic? Or is it like we're projecting $1,400 and that's too much? So trying to get a grasp of those numbers is, I think, something that books don't put enough emphasis on. They kind of just say, use a 3%, you know, rent growth a year. And I'm like, well, that might be not enough, you know, that might be too much. So getting that sense is really where you need to start talking to local people in the market, talking to brokers, talking to lenders, and talking to property management. So that'd be my main things, is get a grasp, because even as a passive investor, those are things that you can check out. And as a because I still invest passively in some deals, and I'll call the properties around there and get a sense. I can do it from my house here, you know. But I go to markets and I sit, you know, I mean, I was in Dallas last weekend, literally just sitting at one of my properties for like an hour, just kind of sitting outside, just feeling who's walking around there, who's outside, you know, what are those people, what kind of shoes they're wearing, what kind of dog do they have? Like, you get that real sense by being on the ground and feeling out the market. So that might be my quick answer there.
Sarita, what other questions have come up? I want to try to hit as many as we can, sort of like a fire roundish.
So there are none, no more in the chat box, but I wanted to ask, what do you guys use for underwriting? Like, do you have a software? Do you use a company? What would you suggest for someone like who's just beginning? What is your opinion on that?
Sure. So, well, I'll just start off on this, and it's like we have our own underwriting tool. So we do have, you know, it's like software that we built basically, right? And it's, you know, but if you're just starting out, you don't need to build your own, right? You don't need to go through all that. There are underwriting tools out there, right? And there's many underwriting tools out there. They're all probably pretty good. You just need to like figure out how to manipulate them, how to, you know, how the formulas actually work inside of them. But I don't think you need to spend a ton of money on figuring out underwriting tools, but you do need to get good at underwriting to the point where you can understand how things can be, you know, when you change certain things, how does that drastically affect, right, your overall projections and what happens to your pro forma, right? So you need to be good enough to understand, like, the little tweaks that you do, how are they, you know, changing out the whole pro forma. The reason why I say that too is because a lot of people trust other people's underwriting, and underwriting to me is as much of an art as it is a science. Like, yes, there is a certain science behind it that you need to plug in these certain numbers, certain places, but there is an art behind it between reading out why are they projecting this much rent growth? Why are they projecting this much in terms of, you know, cap rate, you know, the regression numbers, or why are they projecting this? You know, all of this is really kind of the art behind it. And this is really where you're saying, am I trusting these numbers? So sorry, I got off on kind of a tangent of like actual tools and everything, but yeah, that's what I would say as far as like underwriting tools. What about the rest of you guys as far as underwriting tools? Anything that you use or have out there?
On our side, we use trusty Excel more than anything. At the end of the day, that is what the backbone of most of these softwares basically are anyways, right? Some sort of spreadsheet. And I think it's good for you to understand what the different calculations are that go into that. And then the software just kind of simplifies that process later on. It makes it a little more expedient, faster. We've basically been able to create a lot of revisions and a lot of changes and tweaks and adjustments as needed on the fly based on how we're doing things. And a lot of that really comes down to Excel and then our process that we built on top of that. And even in the past month, we've been able to 10x our volume basically of deals that we look at simply through adjusting how we do things within Excel. But ultimately, there are a lot of tools out there, like Powell mentioned. They all more or less do the same thing. They typically do a pretty good job, but I think it behooves you to understand what is going on behind the scenes. That way, it's not just, okay, I plug this number here and I get this output, but I don't really know what the mechanism is that's causing that. So our bread and butter here really is Excel. And I think what you're going to find is mostly anyone who's in the finance world typically is going to have a pretty strong competence in the Excel technology.
I'll chime in with, so Michael Blanc has his syndicated deal analyzer that I would say I recommend to everybody, and not just because it's the tool, but it comes with like 12 videos of how to use the tool. If Tariq gave his analyzer Excel spreadsheet to everyone in here, I would say 3 of us could probably use it. I probably couldn't use their model off the bat. I would go, show me how you use this. So I think any kind of tool that you get, I posted a video, it was basically just a search on YouTube of my buddy David. He's got, I don't think he sells his analyzer tool anymore, but he basically walks through using his tool, how he uses it for like hour-long videos. So that is, it's like imperative, because if you hand me David's tool, I mean, I use it all the time, but if you hand someone else David's tool, you're like, oh, this is a 8-page spreadsheet that everything interconnects, and you change one thing and it messes everything up here. So that's not helpful to you if you don't know how to use it. So Michael Blanc's syndicated deal analyzer has a great video series. It's only like $150. It's like the best money you'd spend on a tool, because you learn how to use that tool. And then if you buy, I don't know, like I said, I don't know if David sells his tool anymore, but he has videos I just posted that walk you through how to use his tool. So I would say whatever you do find, you got to figure out how to use it first before you. And I think everything is mostly based in Excel at some form or another. So that'd be my.
And to that point, I mean, I'll add to that Michael Blanc's tool is great. Right? We definitely used that once upon a time, and as a starting point, I think that it's you're going to save a lot of time kind of looking at what's already built, and then you can reverse engineer that if you want to understand it, and then you can customize it and tweak and evolve it later on to fit your process, your needs as you need, right? But Michael Blanc's tool is great. There are many others out there, but find something that is already being utilized, reverse engineer, understand it, and then expand it to fit your needs.
Yep, 100%. Okay. Hey, Sarita, can you make Garrison a co-host? Garrison, we're going to be breaking us up into our breakout rooms, I think, right now. Again, my mouse doesn't work, so I can't really do anything right now. Can you break us up into maybe like, I don't know, maybe
we'll give it 4 or 5 people per room. We'll go We're going to create a breakout room, and then we're going to open this channel up. Everyone will come back, and then we'll open this channel up for networking or anything that might go on afterwards. But feel free to hop in a breakout room in 60 seconds.
Awesome.
Everyone back?
I think
Looks
we're
like
back.
we are. This was Multifamily Masters Live. Thanks so much for showing up. We will keep this channel open. Feel free to hang out. Feel free to network. I've actually seen this thing open an hour from now. We won't shut it down. We will stop the recording,